Ted Rossman, senior analyst at Bankrate, joins us now. Ted, welcome. So the Fed is giving us some guidelines when rate cuts may come. What are your thoughts on that?
Well, it definitely wasn't today. It's almost certainly not going to be next month. September is potentially a meeting to watch. Although the higher for longer camp does seem to be gaining steam. There were actually 7 of the 19 participants on the Federal Open Market Committee who said that rates may not fall at all this year. If they do, it seems like September is probably the earliest that would happen. The base case, the median estimate, is still for 2 quarter-point cuts this year, maybe one in September and one in December. Still a lot of uncertainty moving forward about tariffs and jobs and the state of the economy. But the net for consumers is expect higher interest rates to be with us for a while longer.
So if we can get to the nitty-gritty of the net, what exactly do you think will be the impact of that Fed cut? Will it mean lower mortgage rates? Will it mean lower rates on car loans?
It's good news for savers, bad news for borrowers. The fact that rates are likely staying higher for longer. The average credit card rate right now is around 20%. That's close to a record high. That's not going to move meaningfully anytime soon. The average 30-year fixed mortgage rate is 6.9%. We're looking at about 7.2 for the typical new car loan, 7.6 for used cars. None of these rates are likely to move all that much this year, which has borrowing kind of on pause for many. I mean, it's still not a great time to jump into the housing market or buy a car. I mean, certainly some people are doing it, but the rate landscape is not likely to change a whole lot this year. Even next year and the following year, the Fed adjusted their median projections up a little bit. So the so-called terminal rate, like wherever interest rates eventually land, might be a little bit higher than we previously thought. That neutral rate might be creeping up a little bit. I mean, even a couple of years from now, we might be talking about short-term rates that are a point and a half lower than they are now. The Fed still wants to wait and see on inflation and jobs and tariffs, and they're just not ready to move just yet.
Yeah, Ted, how much will the Fed have to cut rates, do you think, before it really makes a difference for people?
It depends on the product. I mean, something like mortgage rates, the Fed doesn't directly set those rates. They more tend to track long-term 10-year treasuries, and investors have a lot to say about where those rates are going. The Fed's important, of course, but they're also factoring in inflation and economic growth. And, in some ways, there's a little bit of a be careful what you wish for, that if mortgage rates were to drop substantially anytime soon, it would probably be if something bad happened to the economy and people were worried about recession and unemployment. So we don't want that. We want rates to come down for good reasons, which would be inflation easing, the economy staying in solid shape. So lots to sort out there. I mean, if mortgage rates did fall a point, let's say, by this time next year, that could free up some activity in the housing market. I mean, it's a big if, but that would put rates below 6%. They're not going back to the 3 or 4% that we saw a few years ago anytime soon, but that would help. For something like a credit card, though, you're hardly going to notice there if it's 18 or 19 or 20. I mean, those are all high.
Yeah.
All right, Ted Rossman with Bankrate, thank you so much for your time tonight.